And welcome everybody to the Horowitz Company pop-up Q&A webinar for the 5th of October 2020. Thank you very much for joining us today. And you know, it's funny, I look back on when we began this, which was, I have a notepad of all the notes from all the different sessions. It goes back to pretty much the bottom of the market where things were really out of hand, where there was concern that the world was going to end. It was back on March 25th, 2020. And here we are when I mentioned that day that we're going to continue this thing as long as there's interest. We're all the way through October. And while there's been a lot of healing in the economy, a lot of healing in the markets, the fact of the matter is there's still a lot of concern out there for what's going to happen next and how we're going to be able to get through all of this. So we're going to keep on working on this and keeping on going with these discussions, answering your questions as they come in each and every week. So to make sure to stay tuned. And also, if you want to, tell your friends, give them the link for registration, because you'll probably be doing them a big favor having the opportunity to have someone answer some of the questions that they may have with regard to the markets and what's going on. I want to mention, as we do each time, of course, that nothing we discuss is a recommendation to buy or sell any security. Past performance is no indication of future results, and this is primarily and solely for educational purposes only. So keep that in mind. All right, well, there is no shortage of news. There's no shortage of market-moving issues out there. I mean, as soon as we take a breath, it seems that we're smacked directly right in the kisser with something else, and the things that have happened over the last 2 weeks, because we weren't here last week, have been pretty amazing. And what's really amazing in all of this, that for the most part, markets didn't react too negatively. I mean, we had the big debate debacle. Anybody that saw the debate walked away with the comment, oh my, that was something. Something that we've never seen before and hopefully never to see again. We had news on stimulus and the plan from both sides of the aisle of, well, we want $2 trillion. Well, we're only giving you $1.5 trillion. That's all we're agreeing to. Or back and forth, back and forth. We have an agreement. We don't have an agreement. And the continuation of the misery for many millions of people who are out of work and whose jobs are possibly on the brink, whose businesses are failing, the potential for eviction, no place to live, hard time getting enough money to buy food, that is continuing. We now have COVID in the White House, and it seems that every 2 or 3 hours we're getting a new name of someone who was close to the president, involved in the debate prep, or possibly even at the nomination, I guess it was meeting, or the Rose Garden ceremony, where the president nominated a new Supreme Court justice, and they were all pretty packed in and tight there without masks on, and that was a big issue. We have several other people, McInerney now, the press secretary, and we have Chris Christie, and we have just a whole, I don't know, maybe there's a dozen or so people right now, and the news that President Trump was in the hospital and was low on his O2 saturation and taking experimental drugs with a fever, and now today, the announcement that everything is just fine. In fact, he feels better than he's felt in 20 years. So he's going back to the White House supposedly at 6:30 p.m. tonight, and everything is, I guess, okay there. We have the unemployment report that showed a lot fewer number of people that were getting jobs this period. So all of this is kind of hard to unpack because it's so intense, and I get it. And if you're watching very closely on a regular basis, it's overwhelming. It really is. What I talked about on this week's podcast, the Disciplined Investor podcast, was the idea of getting your nose away from any screen and stepping back a bit. Now, you could step back 10 feet or 20 feet, and it's still a very difficult environment to absorb all that's going on right now. But the fact of the matter is that if we kind of put it into context of where we are 30 days out from an election, the potential for the pandemic kicking up again, the fact that the markets are being held up, and we'll talk about that in a second, the markets and the news are separate, at least right now. They're not always that way, but right now they've been kind of separate. They've been moving around a bit with the concern about another wave coming, of course, and with all the issues regarding the economies around the world. But this whole idea of focusing too much on what every bit of news that comes out, whether it's financially oriented or it's just something about the economy or it's just about the country or another country or whatever's going on, whether there's bombs going off in the Straits of China or there is a lockdown that's happening potentially in Ireland or 9 zip codes in New York going through another lockdown period or Florida opening up for 100%. All this news, again, is very difficult if we take it piece by piece. Here is the point, though. Markets have been able to brush a lot of this aside. Now, you may be thinking, well, what is wrong with the markets? There's nothing wrong with the markets. There's nothing wrong with you. It's just that right now there is an incredible amount of support. There is I would say, historic liquidity that is involved in the markets right now. And that being the case, markets are trading to their own beat entirely. Where the Fed has rates at historically low levels and says they're going to do it for some time. Matter of fact, the Fed talked about that now they're going to be holding rates down till 2023. Where we have incredible amounts of liquidity through quantitative easing, fiscal stimulus, monetary stimulus, not only here but around the world, it is fueling the idea of where am I going to put my money? And right now there is no better place to put your money than, let's say, maybe certain real estate, possibly the markets, maybe certain commodities. So when we think about this, we're supposed to have a negative bias, right? I mean, where we've seen that the polls, if you choose to believe them or not, but let's just go with the idea that there's some believability if we take the totality of all the polls that are out there, that Biden is leading the polls. And there was this narrative and a negative narrative that if Biden was to be elected, what would happen? Well, markets would crash. Well, after the debate, the odds of Biden being elected went up dramatically. And then with Donald Trump contracting COVID and concerns about his long-term health, well, that was an issue. Markets blinked. They didn't really budge. They blinked. They didn't budge. So again, it's all about liquidity, Fed injections, low interest rates. And that's the most important thing that we need to be dealing with right now, in addition to the constant carrot that is being dangled in front of us, that the Fed is going to be there and there's going to be more stimulus to the tune of, I don't know, $1 trillion. Is it $1 trillion? Is it $1.5 trillion? Is it $2 trillion? Does it really matter? We're talking about $1 trillion of stimulus that will be directly injected into the economy. It doesn't go around to other parts, a lot of it. It just goes right into the economy because it goes right in to the pockets of individuals. And then what happens from there is they spend it. So even with all the things that we're seeing, the worse than expected unemployment numbers, the hospitalization of Donald Trump, the European lockdowns, New York, the anticipation of a stimulus bill north of $1 trillion is really helping to hold up the spirits and the confidence of investors. And what happens is that there are a lot of hurdles that are maybe holding things back, or at least keeping things from really getting to the next level, that next leg up, if you will, aside from stimulus, which is very important. We have earnings coming up. Now, this is, I think, going to be, and I say this every quarter, I think, but I think it's going to be an important quarter. And the reason for that is that we are still a little bit blind to outlook, guidance from many companies. And the question is going to be, have, once again, analysts that are pushing out the estimates for many of these companies coming in a lot lower than the realization of where they should be, allowing for companies to beat a very low bar, thereby creating an environment where there are a lot of corporate beats and the headlines come out and investors just jump on. Starting on October 12th, we're going to see the beginnings of the earnings from the banks. And what we've seen over the last several quarters were that they did well. They beat for the most part, not every one of them, but they beat. There was excitement, anticipation, money pushed in, and then all of a sudden a realization of, wait a minute, we still have a yield curve that's pretty flat here. We have an unemployment rate north of, last period it was north of 9%. Now it's in the 8% range, right? Maybe just below that, 7.9. And we still have a lot of trouble with the fact that a lot of people aren't paying their mortgages and evictions because people aren't paying for their rents, and that flows up into the landlords. The landlords aren't paying the banks, and the loan provisions are very substantial. So all of this goes into play right now. And really, with the election straight ahead, again, markets not really looking forward to looking at what's happening right now, here and now, right now. So maybe it's not as concerning that Biden's coming in. I don't know. It looks to me as though that either there was a lot of hullabaloo about nothing, about the concern about if there is a Biden presidency, that there'll be an increase in taxes for the corporations, a rollback of the rollbacks of the regulations, or a rollback forward of the rollbacks of regulations. But it seems to me right now that there's a lot of just simply everybody's saying, I don't care. And the only thing that we could really identify that with is the fact that we're not caring because we believe that nothing matters to the markets. Because nothing matters because we have a safety net. We have the Fed. Nothing matters because, worst comes to worst, let's get more stimulus. And as long as we have a high unemployment rate and as long as we have inflation that's not too terribly high, we're going to have the support of the government funding the economy during this period. So individually, we may have a lot of problems and people will have a significant amount of trouble. But when we take it in its totality and we look at what's going on here, that there is more money that's flowing into the markets indirectly through stimulus than ever before. And I know that we talk about this stimulus a lot, but it's a really important factor. Where we have extraordinary low interest rates, where there is no place to put your money. We've talked about TINA, there is no alternative. We talked about the ZIRP, zero interest rate program, pretty much for the next 3 years. And that's all playing to what's going on right now. And therefore, we have to be, and I've talked about this before, we have to be, concerned, but not hysterical. We have to be cautious, but not fearful. We have to also be participating, but that doesn't mean we have to be in over our heads. And that's how we design our portfolios pretty much across the board. Our TDI managed growth strategy is a different animal. It does it by itself. In other words, we do it, but we look for stocks that meet certain criteria, and right now we just can't find them. So that's an issue. We look for valuation in places that we want to invest around the world that makes sense for any appropriate risk tolerance in our global allocations and with Investology. And we have those set up for the longer haul, for the right time horizon. But again, the valuations, they're not compelling. Not compelling. I'll mention at this point, if you have questions, we're going to get to them in just about 2 minutes. Put them in the Q&A panel right below there on the, or above, depending where yours is, in the Zoom bar. You can ask your questions. And I want to mention to you, just please do not feel embarrassed, shy. Probably nobody else knows you on this discussion. And we'll just kind of mention your first name. You can actually ask anonymous questions as well if you really don't want to have your name out there. But we will answer everything that we can, and there really is no limitation on the questions. This is something you just don't understand that's been bugging you. Something during the week last week that you thought, oh, what does that mean? Well, ask and we'll try to get to the bottom of it because I think it's important, and that's what this is all about. That's why we're doing this each and every week. So this is your time. It's for you. It's to get you where you need to be in terms of your understanding of what's happening. I do my best throughout our podcast each week, The Disciplined Investor, DH Unplugged, and this to really give you some insights that I think that we're seeing on a regular basis, that we're finding and how we are actually utilizing all the things that we have and the tools that we have at our disposal to keep people invested appropriately for their particular level of risk. And I got to tell you something, one of the pitfalls of investing is sometimes we go either way too conservatively or way too aggressively as individuals, when maybe we shouldn't. In other words, it's very tough to diagnose your own condition. You go to a doctor. It's very difficult to necessarily, as I always say, cut your own hair. Now, you could cut your hair as you're looking in the mirror, even though it's backwards and all that, in the front, but trying to cut the back of your hair is something that's kind of invisible. You never see the back of your head. That's when you need to bring somebody else in, and that's kind of how we look at it. We're here to cut the back of your hair. We're here to look over your circumstance and make sure that your portfolio is proper for your particular circumstance. And then that can mean either a trading portfolio or a long-term investing style portfolio. Anyway, so ask your questions in the Q&A panel, and we'll get to them. So I just want to finish with a couple of points here, and I think it's really important these days, and I think it's something that really has been something that we talked about this week in this week's podcast, the whole idea of the undermining of information, the disinformation campaigns that are going on with social media. And it's really important, I think, right now with what is happening only a month away from an election to really take everything that you're reading, particularly from social media, with a grain of salt. Because remember, nobody that's on there is vetted by any particular agency or any particular group out there. That anybody's individually can say anything they want about anything with no facts, or making up some facts and passing up around other things and reposting and resharing things that are questionable at best, that maybe they don't even know where it came from. So be very careful right now. And this is why when I talked about this week, and I made a really important point of it, to step back. Step back and look from a distance until some of the smoke clears right now, particularly till after the election. Till after we get through the entirety of the election, let's just kind of do a little bit of a, okay, I'm not going to get my nose right on the screen. I'm going to look from a distance. I'm not going to make any crazy decisions until I can see really what is happening with the outcome. Because if you remember something, there was an incredible amount of information out there, and again, a narrative that formed, that if Donald Trump was elected, it was going to be the end of the world as we knew it, and the stock market in particular was going to crash. And that happened for 5 minutes. And then at 3 a.m, he announced that they're going to make a major tax cut for corporations and put together a first line of business, big tax cut, and markets didn't look back for a couple of years. So just something to think about, that maybe there isn't, necessarily an all-in-one and a very easy to come up with scenario whether or not Trump is reelected or Biden is elected. And yes, we know already from the platform that Biden has made it very clear that he's going to raise taxes on the rich and on corporations. So that definitely could dent profitability of companies. Question is how much, and will it actually hurt the entire economy, or will it be something that will actually strengthen the economy by cutting down some of the debt that we have, allowing for our country to grow again in a different way through whether, I don't know, this Green Deal or whatever else is going on. We don't know yet. We don't know if it's actually going to be implemented either if he gets elected. So again, whatever the particular outcome is in this election, I'm not taking sides here. I'm just looking at it from a market perspective. All right, we're going to get to your questions. Put them into the Q&A panel, and we'll go through those until we have no more available. So, first question is from LB. That's how we'll do it from now on. We're going to do it from first names and initials. And LBS, can the average guy investor, or I guess gal investor, find CDS data? If so, where? So I think what you're looking for here is the data on the pricing of the cost to insure against the potential bankruptcy. And CDS data, this is something that was really big back in 2007, 8, 9, where we were looking at the cost factors that were being put against the banks in particular. And the CDS was something where, let me just say what it is, credit default swaps. These are the insurance against the failure of companies. And if a company did fail, it would pay off. It's kind of like insurance, if you will. So the only place that I know, now there's several places, the average guy, probably not. You could probably go to Bloomberg. Bloomberg has that data. Most of this stuff is a little bit more, I would say, for the professionals, for the hedge funds, for the institutional investors. So I don't think, if we really want to get to it and answer your question, if the average guy can find information on CDS, probably not. Not on a very in-depth basis. Carl asks, there are many different sentiment indicators. For example, the VIX, the put-call ratio, the AAII investor survey, bull-bear fund momentum, bull-bear fund investment ratios, etc. The VIX is a coincident indicator. What about the other sentiment indicators? If one sees an excess bullish reading from one of these indicators, what is the duration of the signal? What about the KRI indicator? So one of the things that I like to see in many of these is, I think it's important to look at several maybe that will confirm each other. There's the CNN fear greed index. And as you mentioned, when you see some of these indices, they are contrarian. So for example, when you see these people too bullish, well, you're thinking markets could come down if they're that way for a period of time. The VIX you mentioned is a relative coincidence indicator. Put call ratio, how many people are buying the puts versus the calls. And, if you have a very low reading, well, maybe what's happening is nobody's buying puts. And if you have a too high of a reading, everybody's trying to buy insurance. The duration of these usually is this, that if you remember something about markets, I think this is really important. Markets generally go up. Now, you may say to me, what are you talking about? The big picture. Markets go up. And there's reasons, there's market mechanics that are behind this. And this is something that's really important to understand. You have pension funds that are constantly investing money. You have 401k funds that are weekly, monthly putting money to work. You have investment people with IRAs that are putting money to work. And usually what happens is people are always of the mindset of, I'm going to buy, I'm not going to sell. And most people don't short. So what happens is you see these things build. And you get these excessive readings on the bullish side over time. And then usually these are elongated periods where people are just mechanically putting money into the markets, and then they get, something comes over them. And they're like, oh my God, I got to put it to work right now. And you get these spikes of either a spike down in the VIX or a spike up in the bull-bear fund investment ratio, or you get the put-call ratio that drops to nothing. All these things that you want to look at, or the KRI that we like to look at, which is a key reversal indicator from Trigger Charts, something we programmed over on the TradeStation trading app platform. These usually will happen over time. And what happens is that you'll see that they start to get overdone in one direction or the other. And then usually you'll see the signal is a overheating to a point that it stays there, it doesn't resolve, and it becomes to a point that it's almost like a pot of water boiling that's blowing the top off of the pot. And then the correction comes. And that correction is not usually very long, the initial or next correction. Usually what you see is a very quick move vertically through time of the markets. Have you ever noticed that, markets move up and it takes time over time, they move up or they slowly move down or whatever, but they have these moments that they have these launches out of nowhere higher, or these incredible moves down and correct quickly. Corrections last what? A month? 2 months? I mean, you may have a long-term bear market. That's something different. But I'm talking about corrective actions in markets last for a short period of time. And oftentimes what you find is when you see those, you bottom out very quickly, and those become buying opportunities on the reverse of that overly bullish sentiment. So usually, my opinion, you got about a 30-day window when you have an excessiveness, when you start really heating up to a point of no return. And then when you see that drop and you get that flush out of that is where you have to start thinking about, hey, you know what? I'm going to slowly but surely get some money working here. So I don't know if that helps. Hopefully it helps. Another question from Carl. There has been Minimal Fed asset purchases since July. Would you believe this is to continue until November so as not to influence the election? Yeah, that's a good point. Historically, have Fed asset purchases been minimal in the months leading up to the presidential election? So, Carl, I think the problem we have right now is that we're not in a normal circumstance. We're not in a normal time period. We're not in a normal election cycle. And what I mean by that is that we're in a pandemic, first and foremost. We are in a highly erratic economic environment with millions and tens of millions of people unemployed. Now, normally under an election cycle, what you would find is the Fed keeps their nose out of the process because it's supposed to be apolitical, non-political, which is not necessarily the fact, but that's what they intend and hope to achieve. So usually in that time period, they really don't want to move things in one direction or the other to help out either party. But in this circumstance where we are right now, I think there's a whole different mechanism that's really at play right now. I think that the Fed is doing what they can to keep interest rates low. And if they don't have to purchase any more assets, more than the trillions of dollars they did, I think, $3.5 trillion, that spike up that we saw in the April through June period, we'll call it. I mean, I think they're trying to rest right now and see how this really plays out and how this works for markets. And if, in fact, any further ammunition is needed to get things going. So I think that one of the big issues right now that you really have to realize is that I think they're holding back up until we see the final election results, not to mention the fact that markets are really not off that much from their all-time high. Valuations are stretched. Inflation is coming. And they I think, admitted it. It was a tell. It was a wink and a nod when they said that they're going to allow for inflation averaging. We talked about this. That was their way of telling us inflation is coming, and we want you to be prepared for it just till you let you know. Even if it comes, we're not changing our stance. Because we're going to average out what happened over the last couple of years below the 2% bound. And you know what? If it goes up a bit, well, we're going to be okay for a while. We're not moving. They telegraphed that pretty well. And that's why I believe you're going to have some inflation in the future. Now, if we don't get inflation, now, because we have high unemployment, because we have the tariffs, because we have excess debt, because corporate and sovereign, if we don't get inflation of any reasonable measure, especially with the hoarding that's going up to stockpile ahead of any kind of wave that comes from the pandemic, the supply chain problems that we have, lumber prices off the charts, commodity prices moving up, food prices moving up. If we don't get inflation now, then it's going to tell you they can never do anything to get inflation going with what they've done. So, but to answer your question, I think the Fed has historically been on the sidelines beforehand. I think it's a little bit different this time. We have some time for some further questions. If you have questions, please throw them in. We have about 2 or 3 more questions coming in. Tim asks, or he says, Andrew, great TDI podcast. Woo, thanks, Tim. Especially about the risk of our information as it pertains to TikTok. Yeah, I had a great time talking with Dr. Smith this week, Richard Smith, on the podcast. We were really going to focus in on the idea of TikTok, but we got into the whole discussion about social media and how social media has their hand in your pocket, is ripping out not only the information of your pocket, but of your brain too. And we talked about the misinformation campaigns that are out there, but we also talked about the destructive nature of certain social media. And we really wrapped it into what this whole TikTok deal is, the importance of it, and why the administration wants so badly to essentially shut it down or to wall garden the information that is there from America. Anyway, Tim goes on to say, sorry, I got a little aside there. He says, this is the first interview I've heard describing some of these concerns. How do you see this play out for our investments? Chinese investments in the U.S. and U.S. investments in China, regardless of the election outcome. Again, Andrew, great interview. Well, thanks. So, by the way, that's somebody else saying it. If you haven't listened to this week's Disciplined Investor podcast over on Amazon Music, that app, if you have Amazon Prime, of course, on iTunes, been there since 2007. and where else? Spotify. Plenty of places you can find it. All you have to do is type in Andrew Horowitz podcast and you'll find it. Over on the disciplineinvestor.com as well. So, Tim, I think that there is some concerns that are raised from this because while China basically shuts down a lot of the social media that we have over here, so Facebook and Google to a degree, other companies that run social media are pretty much shut down. You have to use a variety of sneaky ways to try to get around, to try to get that. That's why they've developed Sina, and they have WeChat, and they have, the list goes on. Sohu, some of these were bought recently by Baidu and Tencent. But basically what you have is a situation where the administration of the United States is forcibly trying to dislodge a company that is making a lot of money here in the United States. The information, actually what they're trying to do is dislodge the entire company to be owned by a company in the United States. Well, that doesn't seem to be flying. Chinese government is like, no, that's not happening. So what happens next is, okay, well, we'll get Oracle and somehow Walmart involved in this, but let's put Walmart aside. We have Oracle that will then create a very secure mechanism for housing the data, the personal information, and all the data about all the people that use TikTok in the United States, within the United States, not allowing that information to flow back to the company because the company, ByteDance, is, of course, partially owned or, by the Chinese government. I mean, that's the whole point of the big argument that we have, is that a lot of the companies and most of the companies in China are owned by the government. Therefore, they can never fail. Therefore, there's a question about data, privacy. There's a question about a lot of things, and that's what the big issue is right now. So now what's happening here is that we have a situation where we are trying to dislodge this. We are trying to, they don't like it. They don't want it. They're like, no, I don't think so. They're talking about shutting down the whole thing in the U.S. Just like Facebook is shut down there. And in a way, kind of they're right. In a way, we're right. In other words, our companies aren't allowed there. They're concerned about Facebook and all the things that go along with social media and all the things that are unconstrained in their country, in a communist country, and they're not allowing it there. They're just not going to put up with it, so they just block it. Essentially, we could just block TikTok as well. Well, unfortunately, we tried to do that. It's not working. I think there is some issue of concern about other companies, and we're already taking down others as chip companies that we're not allowing. Huawei's a problem. We are in a battle for the intellectual property. We're in a battle for the data. We're in a battle for the eyeballs and for the information that is provided, and we don't want to share that because we're concerned about disinformation campaigns. We're concerned about how they're going to use it possibly in hacking or phishing scams. We're concerned about them knowing about our economy and the strength they hold then above us with our, we have so much of a dependence on them that we just don't want that. That's what our administration and what we're saying. Now remember, we built this. We created this. It's all our doing. Over the last 20 years, we created the Chinas, the Vietnams. We created all the different emerging markets. We wanted cheaper products faster. We didn't want to have, our companies didn't want to pay the overtime. We didn't want to pay the labor costs. We didn't want to pay for the benefits and the pension plans and the retirement. So what did we do? We outsourced it with the blessing of our government. Now we get t-shirts that are $3 instead of $12. We're happy. We talk about, well, we'd like to bring that labor home. Yeah, we'd love to bring that labor home. You know what? The cost factors involved in it are going to be prohibitive. Just for the health care, just for the time off and vacations and the cost of the retirement and the cost of everything that goes on within the cost of labor in the United States, that same t-shirt is 4 times the price here, at least. It's a big difference. So I don't know if we could totally extract ourselves maybe from China, possibly to a degree, but then it's just going to open up somewhere else. It'll be the Philippines. It'll be Thailand. It will be Vietnam. It could be some areas inside Latin America. This is, or maybe even emerging Europe. This is an issue that is going to be very difficult to really tackle And I don't think that the way that we're going about it's really going to get us anywhere, because a lot of people are going to fight this tooth and nail. But we'll see. I don't know if that gives you an answer to that, but it is going to play out. It's going to be interesting. Remember, we got 30 days with this current administration that has been pretty tough on China. Whether or not that's going to hold with if Trump is reelected and he's going to continue on with this, which he will, or if Biden comes in, if he backs off, or then even presses further, we're going to have to see how this plays out. But this is just the tip of the iceberg with this TikTok issue right now. So stay tuned. Ken says, what does a bond collapse look like? That's interesting. Right now, the theory is that rates go up, interest rates go up, and what happens is that because rates go up, the cost involved in refinancing debt that you put out there, the extraordinary amount of debt that you put out there, goes up to a point that you can no longer support that debt. This is why the government has issued so much debt at low cost and why the Fed is keeping rates low. They know if they jump rates up, what happens is with the maturing debt that comes, there is a much greater cost to the economy and to the government to pay off the debt service on the new debt at higher rates. If you have a spiral, by the way, let me back up. We had a bond collapse. Right now, we don't have what should have happened in March and April, because we are being kept alive by the good grace of the Fed that is buying bonds, both sovereign and corporate, keeping alive companies that have no profits and no business being around, unfortunately, due to what happened during this major recessionary situation due to the pandemic. But companies are able to issue bonds. If companies weren't able to issue bonds because people weren't willing to buy the bonds at those prices, well, prices would go down, rates would go up, and we'd have this major collapse that we did see in March and April until the Fed stepped in. So you saw a bond collapse. You saw exactly what it looks like. Go look at a chart of an ETF or a bond or a mutual fund that holds high yield bonds and corporate debt. Look what happened, 30% cut in March. That would have gotten a lot worse if the Fed wasn't there to pick up the pieces. So you did have a view of what it could look like. Aaron says, when looking at healthcare, what's your criteria for investments? Not personal healthcare. Not personal healthcare. When looking at healthcare, what is your criteria for investments? I'm not clear. I understand that. Not personal healthcare. First of all, we're not biotech investors. I don't think we could pull that out. We really look at more so of a sector, but we don't really get down to that level. There are certain stocks that meet criteria, and it doesn't matter if they're in the healthcare, automotive, doesn't matter if they're in technology or utilities. As long as they meet the criteria of growth over time, that's how we invest. So I really don't have an answer for you there, Aaron. I'm sorry. We don't really go for a specific sector, specific stock, and just go from that aspect. Last question, interesting question, actually. It says, hey, Andrew, could you discuss the economies of podcasts? I know you are on lots of services, but how do they differ insofar as monetizing them to the podcaster? So there are all sorts of different models. There's a donation model that you can have. There is an advertising model that you can have. There is a direct business or a services sale that you could have. I'm probably missing something here. So let's see. Direct services, donation, subscription. You could have a subscription model. So it all depends on what it is. Just by having a podcast does not mean that you can monetize it. You have to pick what particular way you want to do it. For example, some people have podcasts that are videos. They put them on YouTube. They monetize it through advertisements. You have to have a lot of views to get any kind of decent money. Even like 50,000 is not going to get you something. There are others that just like to do podcasts because it's a way of, like, for example, a lot of our podcasts, even though we have some advertisers on there, I just like doing them, and we do them because there's great information I learned from some unbelievable guests that we bring on that educates me as we educate the audience. That right there is kind of payment enough for me in a lot of respects. Yeah, we have some advertisers that are on the show as well, so why not, right? But there's also DH Unplugged and others that I know of. You get donations that come in. People like what they hear. They send something in. But basically, there are several different ways, but I think the major ones are subscription, advertisements, donation, and direct sales of a product of some sort. I don't like, let's say you had a hair product. Maybe you're doing a hairstyling podcast, and maybe you sell hairspray, I don't know, or some product. Well, you could possibly sell it that way, and that's a way to monetize the podcast. So I hope that helps. All right, we're going to end it right there, and see you again next week. Of course, tomorrow night at 9 o'clock, live, myself, John C. Dvorak, on the DH Unplugged podcast, dhunplugged.com. Be there for the chat room. It's a lot of fun. We have a lot of fun talking about things on that show. Otherwise, I will tell you that we will be here again next Monday. Tell your friends, your family. Have a great week. Have a profitable week. I'll see you then. Thanks so much.